Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future. Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnino with NinjaTrader. It is Wednesday, June 28th. We have a great guest lined up for us today. Appreciate everybody being here. Let's waste no time. I am so pleased to introduce Dan Gramza, Gramza Capital Management. Dan, good morning.
Good morning, Jim. Great to be with you. I'm really excited about exploring these markets together today.
Well, I'm happy you're here. But before we get started, though, I do want to do a shout out to my cousin Dave, your lifelong friend, and let Dave know he's fighting the good fight right now. He's a life champion. Dave, we love you. Our prayers are with you.
Amen. Well said.
Let's having said, hey Dave, that's right, absolutely. Having said all that, let's get into it, Dan. We've known each other for a couple decades at least, right?
Oh yeah, I would say so.
Long time ago. And I remember Paris Hotel presentation. They had that conference room between the Paris Hotel and Bally's right in the middle in the hallway there. And we had the two monitors going up, packed house. That must have been 2004, maybe?
Oh, yeah, it probably around there, if not before, but I think you're right. It was probably around then. It was good.
Yeah, absolutely. Now you're in Chicago. You hail from South Bend, Indiana, and you have, I don't know how big your family was growing up, but as I remember, there was a couple of dozen kids, maybe.
Well, we not a couple, although there were some neighbors that did have 15, but we had 7. So
Okay.
and I have 65 nieces and nephews. So we've expanded.
Wow, that's terrific. I love it. That is absolutely wonderful. And I do attribute to you most of my knowledge. I know maybe 20% of what you do on candlestick analysis, but I do attribute you to be my mentor in candlestick analysis. You adopted that early on, and you're pretty good at it.
Well, thank you, Jim. It's very kind of you to say that.
All right. Well, let's kind of move forward here. I mean, right away, today we have a big meeting happening in Sintra, Portugal, macroeconomic stabilization in a volatile inflation environment. That's the title, right? And we have all the central bakers getting together. They've already finished their bagels, coffee, croissants, and they're meeting right now. What does that mean?
Well, I don't think anything new. I think they're all going to stay the course. This is a format where a central bank can reinforce the tone they've already set. We're going to have everybody. ECB is going to be saying their thing. They've already done some things in terms of changing their interest rates. Powell is going to be speaking. So a lot of people are going to look at literally every word he speaks. When a central bank does say anything, every word is parsed. Jim, I got to tell you, when I said that, it made me think of something. Years ago, I was in Frankfurt to do a course, but I have someone I've known for many years at the Bundesbank, and he was an economist at the time, and we were going to have lunch. So I went over there to get a bite to eat with him, and he had this fellow come in and say something to him. He knows he can talk in front of me because I can't speak German. And he walked over to a wall and he had all these binders, pulls this binder out, and he and this fellow are talking and he's pointing at something. And then he closes the book, puts it on the wall. And part of what his job was to put together the speech for the president of the bank. And then he looked at me and he said, "We're putting together a speech and we think we use that word before. And so it says something about this idea of what's going to be happening today in that meeting. Every word will be parsed. Did he say good? Did he see better? Did he say unbridled exuberance? What did he say? And then also, what didn't he say? So as that day progresses, all those presidents will be parsed that way, and including, Powell. People will
Now,
be taking a close look at him.
so do you think that they actually coordinate between each other before they go on stage? In other words, here's what I'm going to say, here's what I'm going to say. Well, could you say this instead? Do you think that kind of level of coordination
I,
happens between the members?
I don't, because you can end up having a mixed message. Right now, there are people in the United States on the central bank committees, for example, that are expecting Powell to say certain things. And so they really would not want to be influenced by what somebody else does, although they are indirectly. Is everybody raising interest rates? Is everybody decreasing? Is everybody pausing? Well, we're not saying that this last go around. So I don't think, I think the idea of a surprise, very low probability. Do most central banks have an idea what the other central banks are going to do? Yes. So I don't think there's anything that we would need to talk about. I mean, what they're going to say is already cast in bronze. It's done in that
And
regard.
and it seems like almost across the board, everybody is leaning toward the hawkish side and saying, not so fast. We're not there yet. We got more work to do on inflation. Lagarde yesterday talked about a second wave of inflation coming back. And that seems to be the common thread across the board. Am I reading that right?
I think you're right on target. And when you think about it, Jim, they kind of have to say it in this way. I mean, the United States, we paused last go around, right? So what the concern is in the marketplace isn't that the Fed really increases, decreases, or pauses. It's when do they increase interest rates? How often do they do it, and by how much? The concern in the market right now, and we hear so much talk about recession, because if you think of the late 90s, if you and I look at the central bank actions in the United States over the last 30 years, in the late 90s, interest rates got up to 6.5%. At 6.5%, it choked off credit to the dot-com bubble. And was it that got high enough to make money tight enough that they couldn't get the credit they wanted? And we saw the market and we saw interest rates coming down. Interest rates went to 1%. Then we had the 2007, 2008. Interest rates are going back up again. We got to 5.25%. And that's when we had the real estate issues and the market kind of collapsed. So where are we? Well, we're at 5.25, and they're talking about another 25 basis points in July. That won't be a surprise, but that's the expectation. But the market's going, holy Toledo. Remember the last time we were at this rate, we had significant financial outcome from that. So are we in a territory now where the Fed may put us in that recession? That's one issue. And then if imagine if you and I were the Fed, what a tough job. Because are we at the objective they want for interest rates? No, we're not at 2%. So what can they say? Doggone it, we're just not done yet. We're going to have to increase interest rates to get inflation where we need to do it, where they think it should be. So that's the script, and I don't see them changing it. It's a tough spot. How much is too much? And the problem, Jim, they don't know. They don't
Yes.
know what interest rate, right, will create the inflation environment they want.
Right now, so interest rates, and I remember meeting with with a lawyer on an unrelated matter, I don't know, 15 years ago, a good friend of mine, a neighbor, and we were talking about what I did for a living and all that stuff. And he just made a comment. I thought it was a flippant comment. It's like, oh, it's all about interest rates. Is that really the nucleus of how all of these different asset classes are priced? Is because of the interest rates?
Well, do you know something? I think it's a very astute observation. It does, Jim. I think that's a good comment. That's a good observation. I think that is correct. I mean, interest rates have an impact on credit, right? How much money is available? So if you think about the United States, there is a fixed amount of dollars out there, right? And what does the Fed do? The Fed has the ability, they have three tools they can use to increase or decrease that big pool of money. And as they do that, that has an impact on, let's say, the stock market. You know, you and I have a company. We want to build a new edition. And we say, you know, something, our return for production, if we build that new edition with the cost of interest rates where they are, I don't think we should do it. So does it have an impact there in that stock market? Yes. If I'm a farmer, my cost to go to the bank to maybe buy land, lease land, buy my seeds, buy equipment, all impacted by those interest rates. And interest rates may determine how much is planted. Interest rates right now in the Midwest, you know, farmers are some are deciding soybeans, corn, although most of them have already made that decision. A part of that decision is return on capital. Where's their break-even cost and what are their expectations for yields? You know, we're seeing that right now. We're seeing the ag markets for, like soybeans and wheat reacting to the possibility of something in the future. And you know, Jim, that's what fascinates me when I think about what you said about interest rates. Uh, the market right now, in the sense, they know Powell's going to speak, so it's going to anticipate what may happen. So when I look at how a market reacts, let's say to an interest rate change, I ask myself, is this fundamental happening? Did they increase interest rate? Or is this about a possibility, which means that the market is reacting to anticipation of a fundamental? It hasn't become reality yet. So I evaluate what the market's responding to because I think fundamentals create that belief that the market can respond to something. I just break it down further. Is it a shock fundamental? Nobody saw that one coming. Is it something expected, like we have numbers coming out this week? Or is it something that the market's anticipating of something that could happen in the future? If it's that kind of movement, and let's say you and I see a big move, well, I want a relatively tight stop because if that anticipation isn't true, this market's going to go down faster than it did going up. If, on the other hand, it's moving because we don't have enough of something, I want more of a looser stop because that could be a trend.
So, would you suggest that because of that, the potential, like you just suggested, the futures markets might be a little bit more forward looking than maybe some of the other markets when traders and investors are considering what asset class to participate in?
Ooh, that's a good question, Jim. Yes, I think it does. I like that. No, I like your thinking because I think it does. The nature of the beast in the sense of the futures market. We're pricing something in the future, the expectation. And to me, you know, Jim, that's what's so fascinating about these futures. You know, when you and I look at the futures market, we're getting an opinion about price at some point in the future. And if you and I look at, you know, a number of contracts, if we look at, you know, 5 or 6 contracts into the future, expirations into the future, we get a picture of what do people think 6 months from now? What are people thinking in the expiration of the current contract? So, yeah, I like that thinking, Jim. I think it makes a lot of sense.
So kind of putting those two ideas together, we have we have every major asset class covered at the CME Group, as an example. And there's this idea of risk on, risk off, and money flowing in and out, sometimes on an intraday basis, sometimes on a longer term basis, between these different markets like gold and energies and equities and treasuries, as an example. How does that interplay generally work in a higher interest rate environment?
Well, let's do it this way. Let's think about if you and I are concerned about the future, that we could be in a recession or whatever else that we're concerned about, we probably want to put our money where it has a feeling of safety. One of those places could be gold. You mentioned gold, that theoretically holds value. It could be interest rate markets. It could be the 10-year notes, for example. And when the way we typically trade in the United States 10-year notes is it's based on price. So if you look at yesterday, 10-year notes went down. And one of the ways that you and I can think about that market, or
And Dan, I'm going to pull up a
yeah,
10-year note
oh,
daily chart right now.
perfect.
And
Yeah,
you should be,
yeah,
yeah. This is just
excellent.
a daily chart right now, continuous
Perfect.
chart.
Perfect. Okay, excellent. Thank you, Jim. So let's talk about yesterday. And what we're looking at is a relationship between yield and price. But let's put the yield aside. When I look at that chart, and let's talk about it from what I call behavioral candles. Those orange candles, those dark candles imply selling, and the gray ones imply buying. And the lines that you see on the top, I think, represent selling, and the lines you see on the bottom, I think, represent buying. Okay, so let's look at yesterday. Yesterday, that guy right there, that's right. If we look at yesterday, we had selling coming into that market. So to me, one of the ways you and I can think about it is that people were selling that market. It means they were taking capital out of that market. Okay, so where does that go? And could you pull up one of the stock indices? Pull up the S&P, for example. Look at yesterday's candle there. Same ideas. The orange represents selling, the gray represents buying. So what did we see yesterday here? Son of a gun, yesterday was an up day. So to me, everything's in balance. Capital came out of, as we saw in the 10-year notes, that red candle, and it went someplace. One of the places it went was the S&P. And so what we're seeing, because yesterday was an up day, what you and I are seeing is risk off and risk on. Risk on typically means that people are willing to take that money that was safe in the treasury and now expose it to market risk, the volatility of the stock market. Yesterday, apparently people felt that way. So to me, that's one of the things I look at. Are we normal? This is normal. So we had risk on as an up day yesterday in the stock market. An example of risk off would be if you see, that orange candle where it's selling off, right? People are taking money out of the stock market. And it could be going to treasuries. It could be going to gold, what they consider safe haven investments. So it's that balance that we're looking at is one of the things I think about when I think about that idea that you mentioned of risk on and risk off.
Yeah, and you hear it all the time, right? And for a lot of us are day traders, and the challenge is looking at that correlation because the correlation that you just pointed out was awesome. It's right on point. it's not perfect. It's not -1. It's not perfectly uncorrelated, but it was certainly a negative correlation. We don't always see intraday, a negative correlation between these two particular markets, which are suggesting to me that, okay, so maybe some money's flowing in another place.
That's right.
Does that make sense?
Yes, yes. And then we could say, all right, well, hmm, as you mentioned, the CME Group has a plethora of choices of where capital could flow. If people are willing to put risk on, does that mean crude oil prices should go up? Agricultural prices should go up? That didn't happen, actually. They didn't, because we also have different fundamentals at play as well. The agricultural markets right now are anticipating that we may get rain. It's an example of an anticipation market. So far, we haven't gotten the rain yet. And, so we'll see it reflected in that type of action. We see natural gas taking off, fairly strong because of some of the weather conditions. It's a market. I've had people say to me, well, what does natural gas have to do with weather, really? Well, if we think about the use of natural gas, a third of it we use to cook our food and heat our homes. A third of it we use for industrial purposes, chemical industry, steel industry. They use a lot of natural gas in their processing. And we also use a third of it to produce electricity. So as the temperatures have moderated in the northeast part of the country, that's had a dampening effect in some ways on nat gas. But if we look at our friends in Texas, and that heat wave is spreading. I talked to someone or got correspondence with someone from Texas, and they just said, thank God for air conditioning. But to run that air conditioner, we got to have electricity, which means we produce more electricity in our country with natural gas than we do with coal. So it's reflected in the prices that we're seeing here right now. But if we get cold temperatures, if we get a change in that environment, if we see the steel industry or chemical industry really dropping in terms of production, we're not saying that, but if we did, then you'd look for nat gas to cool off a bit.
Yeah,
So,
it's been cool for a little bit of time now, but that gets me to China actually in
mm,
my thought process, which is maybe not, totally smooth thought process, but S&P rating agency last night or this morning came out with a rating for China as outlook stable A plus, and an A plus from S&P for a country isn't like me and you getting an A plus on an exam. We're not running home to mom and dad waving the paper around. That's significantly below AAA. So it looks good, but it's not really that good. And with China being a major player, what does that mean with respect to recession and that kind of thing?
that's a good observation, Jim. That distinction that you made, it's right on target. Uh, it does make a big difference, and we see it reflected in these markets. We see it reflected, well, today possibly the Fed or the Washington is saying, something, we're going to restrict sales of uh, AI chips to China. So Nvidia, with 20% of their income comes from China. So to see the stock indices soften a little bit before we get started today, not too surprising. And where we're also seeing China, Jim, where we're also seeing China, really, I think almost a direct correlation to them is check out copper. Can we put up copper? Is that
Yeah, we could do
because,
that.
what's so fascinating, and I'm bullish on copper. I'm looking for copper prices to move up. But the challenge is China consumes 48% of the global supply of copper. So the market has been waiting for China to kick in with, their economy. Their economy hasn't kicked in. We haven't seen that demand. And the result is copper, as you can see, it's struggling. It's backing off here a bit. Today we have a down day in that market, but it's also reflected in what you said. If China has positioned itself because of its consumption pattern, it's reflected in so many markets that you and I look at. But yet, if we think about, let's think about yesterday. Yesterday we had new home sales coming out better than expected. We had consumer confidence better than expected. So it means that people have money and they're willing to spend it and they feel confident or positive, let's say, about the future. And so it's reflected in these markets that we're seeing here. Now, in a new home, we use 400 to 600 pounds of copper. In a car, 40 pounds to 99 pounds, depending on the model. And an electric car, about 4 times that amount. So is there potential demand for copper? Yes. And do we expect that to be hitting this market? Yes. Has it? No. You and I look at that and we can see today, there's pressure on that market. China just hasn't come to the table. So that's a country that people look at when it comes to demand. We see it also in the meat markets and agricultural markets. China's a big buyer. And when they will go to buy soybeans or corn, they look at United States, they look at Brazil, and they look at Argentina. And just like you and I do when we go shopping at the store, we say, where can I get the best bang for the buck or best bang for the yuan? So that's what they look at. So we look for them to come in and participate. The expectations there. And when they don't show up, and we're seeing it reflected here in copper.
This is definitely looking like a bearish chart, and you kind of open the door for currencies a little bit because you did mention it. But we're up against time. But I do want to get this question in because I thought it interesting this morning with the release of the International Trade in Goods report, suggesting that maybe we imported a little bit less, exported a little bit more. Is when I see that, is that a function of currency primarily, which is a function of interest rates?
Yes, it is a big chunk of it. It goes back to the marketplace shops just like you and I do. Like I said, when we go to the store. And so what does have an impact on that decision? The price of it. And what determines the price of it? Well, if the US dollar, for example, if we think about it in currencies, if the US dollar is getting stronger, which means compared to other currencies, I get more of that other currency when I go to buy that currency. It means our goods become more expensive. So maybe people are going to buy less of our stuff. It also means we can buy more of their stuff because we have a stronger dollar. So yes, and it does go back to those interest rates. That has an impact on that. If interest rates go up, there's money managers in Germany I can think of when they look at the world, a portfolio of countries, like you and I would look at a portfolio of stocks, only they happen to be countries. So where are they going to put their money? They'd say, it's like you and I saying, what bank gives me the best return? So they look at the US dollar, they say, hey, I should take some of my euros and put it in the United States. Well, they have to buy US dollars to do that. And that adds some demand to the US dollar as well.
Which impacts the price.
Exactly.
Wow. Well, we packed so much information in 30 minutes. I wish we could keep going. I mean, we're up against the clock. I'm glad we were able to introduce you to the See the Futures crowd and the NinjaTrader crowd as well. What's the best? How could people reach out to you? How could they find you?
Well, I have a website, dangramza.com. There's a free daily video that covers, 22 markets. I pick out different ones to talk about every day. And it gives them an idea, kind of what you and I were doing of some of the fundamentals. It shows buy and sell levels. These are not buy and sell recommendations, but just the idea I want to share, kind of how I'm thinking about a variety of different markets. And so all they would have to do is just sign up at dangramza.com and they can watch those videos. They can go back 8 years or 9 years or whatever it is. If it's recorded every time the market's open, so they can go back and see, okay, what did he say when this happened? They could go back to that date and see that. So
Dan, and I remember when you first started making those videos, and you cover a bunch of different markets, right? It's not just one thing you're talking about. And it's incredible to me. You still do them every day, and it's awesome. They're great products for sure.
well, thanks, Jim. It's fun to be able to share information and yeah, it's stock indexes, currencies, interest rates, metals, ag markets. It's but it's fun and it's watching over 150 countries. Go figure, huh? It that truly amazes me.
Yeah, it's very awesome. So, well, thank you for spending time with us today on See the Future. It's great being with you side by side today. Looking forward to doing this again. So appreciate your time.
My pleasure, Jim. Great to be with you. Thank you.
Thanks, Dan. And everybody else, most important message of the day, remember, please be safe out there. Be good to each other. Thanks for coming.